Think of trading the euro against the US dollar during the London morning session, like driving a high-speed race car on a treacherous track. You are moving fast, making split-second decisions, and the environment around you is shifting constantly. That speed comes from volume. When the London session opens, it handles the largest amount of global foreign exchange trades of the entire day. Money pours in, creating intense, rapid price movements. To understand the sheer scale of this, look at the historical trading floors. That chaos, the shouting, the massive influx of orders, that energy is now digitized, and it pushes currency prices up and down in violent short-term waves. To navigate these waves, traders use a specific tool to measure momentum. It tells them exactly how much buying or selling power is driving the price at any given second. This dial is a popular indicator called the Relative Strength Index, or RSI. It acts precisely like your car's speedometer, measuring the internal strength of a currency pair on a simple scale from 0 to 100. Surviving the volatile London session requires reading this gauge perfectly, but there is a hidden trap. Most beginners step onto this fast-paced track using a dangerously outdated speedometer. Almost every trading platform defaults to an RSI setting of 14 periods. That means the math is looking back at the last 14 chunks of time. The problem is that formula was designed in the late 1970s for people analyzing slow, daily stock movements over weeks or months. Take a look at this split screen. On a 5-minute chart, where we need to catch micro movements, that 14-period setting acts like a sluggish truck speedometer. The price at the top takes a sharp dive, but the RSI line below reacts far too slowly. You'll see horizontal lines appearing here at 70 and 30. These are the factory defaults. Hitting 70 means a currency is overbought and might drop, while hitting 30 means it is oversold and might bounce back. But notice how our lagging RSI line totally fails to cross these boundaries before the actual price has already reversed. Relying on this 1970s default causes traders to get their signals entirely too late. They buy when the price is already dropping and sell when it is already climbing, resulting in quick, painful losses. To capture these rapid price moves successfully, we have to abandon the factory defaults. We need to build a custom, highly sensitive instrument. The first step of our calibration is to drastically shortening the RSI look-back period. We are dropping it from 14 all the way down to a 5 or a 9. As the dial upgrades, watch the line. It becomes jagged and hypersensitive, perfectly mirroring the price wave's peaks and valleys. Step 2, we slide the boundaries outward. The standard 70 and 30 lines expand to an extreme 80 and 20. The London session's volatility constantly pushes prices past normal levels. Expanding to 80 and 20 filters out false alarms. Now, the snappy line pierces 80, flashing a red warning exactly at the price peak, then drops, flashing a blue warning right at the absolute bottom. Cautionary, we now have an instrument with razor-sharp reflexes. But fast reflexes are entirely useless if you are driving your car in the wrong direction. This brings us to a concept called multi-time frame confirmation. Think of it as a satellite map that hovers above our racetrack, showing us the overall weather and traffic flow. If you only look at your immediate 5-minute chart, you are driving with tunnel vision. You might take a corner perfectly, only to find you are accelerating headfirst into a massive wave of oncoming macroeconomic traffic. To avoid this, we follow a strict rule. Before the London session even opens, we zoom out to a 1-hour chart. This shows us the macro momentum of the entire market. On the 1-hour chart, an RSI above the 50 midline shows strong upward momentum. Shrinking this to a mini-map reveals our execution rule. We completely cross out any red sell signals on the 5-minute chart. We are only looking for opportunities to buy. By consulting this satellite map first, we filter out dangerous trades. We guarantee that we are only fighting small, short-term battles that actually align with the trajectory of the larger war. Let's put this all together. Gives us the green light to exclusively take buy trades. On this 5-minute chart, the price drops sharply. Our sensitive 5-period RSI falls below the extreme 20 line. Sellers are out of gas. We wait. The exact moment it hooks back above 20 is our trigger to hit the gas, enter, and ride the price up. By combining the large-scale direction from the 1-hour chart with the micro-sensitivity of a calibrated RSI, you are stacking the odds in your favor. You are turning a blind guess into a calculated move. While average traders are skidding out, losing money because they rely on sluggish default settings, you are smoothly navigating the deepest curves the market has to offer. Calibrate your instrument to match the speed of the London session. Respect the multi-timeframe map. When you stop trading blindly, you can find